Hello, welcome to my channel Accounting for Beginners once again. Those who are watching me for the first time, it is appropriate for me to introduce myself to you so that you know your teacher. My name is Daniel Amwakun, an ACCA Chartered Accountant. I provided accounting services such as bookkeeping and others, including teaching for more than 20 years. I don't want to waste your time. Let us get into the video. Today, our subject is bank reconciliation statement. All those who have watched my past videos know that I teach by simply preparing notes, then I'll go through the notes with you. So it has been simplified in such a way that, and I'll also go through gradually with you so that at the end of the day, you really understand the subject. I teach accounting in such a way that even an accountant or somebody who has not seen accounting book before will understand it. So let us start. So our topic is bank reconciliation statement. Our learning objectives. A, explain why the bank reconciliation statements are done. B, reconcile cash book balances with bank statement balances. C, make entries for dishonored checks. Okay, so number one, meaning of bank reconciliation statement. This is to reconcile the business cash book balance with our bank statement balance. This to ensure that our cash in the bank statement is intact. Either the business or the banks has not made error or errors in the recording of the cash transactions. Any error or errors made are corrected immediately. So bank reconciliation statement simply means you compare your cash book balance with your bank statement balance in order to make sure that they are correct. If there's or they are equal, if there's any errors, immediately it should be what? Corrected. That is when the bank statement and the cash book balance, they do not balance. Then after the bank reconciliation statement, you realize that still there are differences, then the errors should be investigated and corrected. Okay, let's continue. Two types of account with bank. So these are the accounts that an individual or an organization can open with a bank. A, savings account. An agreement made with the bank such that withdrawals can be done at certain number of times. However, due to ATM system, this has been overlooked. The bank usually pays you a commission, mostly monthly, for operating such an account. Usually, individuals operate such personal account. Deposit slips or books are used to deposit monies into the account, and withdrawal forms or books are used to withdraw money from the account. So this is the first type of account. You can open a savings account with the bank, and formally you have a number of days that you can withdraw money from there. But now, due to the ATM system, you can withdraw money at any time. And when you do that, the bank will pay you a commission or interest on the amount that you have deposited in the bank. And if you want to put in money, that deposit money, you use deposit slips at books. And if you want to withdraw money, you use withdrawal forms. That's the first type of account. Let us continue. B, current account. With such an account, a business can withdraw money as often as possible from the account. The bank charges monthly interest. Deposit books are used to deposit money into the account, and checks are used to withdraw money from the account. So the second type is the current account. You put money into the bank and you can withdraw it at any time. The bank will charge you for their service that they are providing, that they will charge monthly interest. You can use deposit book to deposit money or slip to deposit money to the bank. But if you want to withdraw, it's only check that you can use to withdraw. Okay, see, the third one is the fixed deposit account. The business or an individual comes to an agreement with the bank or the bank not to withdraw their deposit with the bank for a certain period. A good commission or interest is paid to the business or the individual. That's the individual or the business will come to terms with the bank that they are depositing a certain amount of money in the bank, but they are not going to withdraw it. The bank will use it and operate their business. Then when that particular period ends, then the bank will pay you the other commission on interest on the account. Okay, let us continue. So number 4, factors that causes differences are in the cash book and the bank statement are A, standing orders. Written instruction given to the bank to make a specific regular payment to an individual or organization at certain period. Example, insurance mortgage, that the bank, the owner of the account will write a letter to the bank that certain payment should be made to an individual or organization. For example, insurance mortgage. Once it has been written to the bank, anytime that particular organization can go and withdraw the money, or the bank pay the amount to that particular individual or organization specified in the letter. Okay, B, direct debit. An instruction given to a business payable to withdraw a certain amount from the bank periodically. The bank is informed about such an agreement. Example is regular electricity bill, that anybody that the business is owing, we call it payable. First it was credited, but we call it payable. Then the bank, the organization will inform that particular payable that you can withdraw such an amount from the bank. Then the bank will be informed. So, for example, electricity bill, then the electricity company can withdraw the amount from the bank. Okay. C, unpresented checks. These are checks issued to customers for payment, but not presented to the bank as such, excluded from the bank statement. Though it has been credited in the cash book, but not debited in the bank statement. That is unpresented check. So the business will pay somebody, other individual organization, and the bank and the cash book will be credited. So when they credit the cash book, it's supposed to be sent to the bank so that the bank will also debit it, but it may delay. So the bank estimation, when it comes, it may not reflect in the bank statement. So that one we call it what? Unpresented check, because the check has not been presented for the bank to debit the business account. Okay. So we have D, uncredited checks. These are checks received by the business, debited in the cash book. Debited in the cash book, but not credited in the bank statement. So somebody that the business is owing will give a check to the business. The accountant will debit it in the cash book. So it's supposed to be credited in the bank. But maybe it will delay so that by the time that the bank statement comes, the bank, if not received the amount here, so it will not appear in the bank statement. It will not be credited. You see that as uncredited checks. Okay, E, credit transfer. An amount may be paid into the bank account that is credited on behalf of the business without the business being aware of it. Example, dividend or shares owned by the business. So the bank can also credit the business. Somebody will pay the business and it will be credited in the bank statement. So it's supposed to be debited in the cash book. The business or the accountant may not be aware, so it will not be done. Example is what? The dividend or shares owned by the business. So that is credit what? Transfer. F, bank charges. This is an amount deducted from the business bank account by the bank from operating what? A current account. So when you operate a current account, the bank will charge you monthly interest. So until the bank statement comes, the accountant will not be aware. So although it will be debited in the bank statement, it will not be credited in the cash book. So you go to G. That is what wrong debit and credit made by the bank. These are errors made by the bank for wrongly debiting or crediting the business bank account. So at times the bank may wrongly credit your account or debit your account, which are what if I have not received the amount to be credited in the bank account, or we've not withdrawn the amount to be or debited in the bank, but the bank mistakenly they will do that. That the wrong debit and the what and the credit. Each errors by the bank or the accountant. These are errors made by the bank in the bank statement or errors made by the accountant in the cash book. So as either the accountant can make an error in the cash book, or the bank also can make an error what in the bank statement. Okay. Now I, bank interest. An amount either paid to you or deducted from your bank account by the bank without you being aware. For example, interest on overdraft you collected from the bank, deducted from your account. So bank interest, an amount can be deducted or what? Amount can be deducted or paid out of your account without you being aware of it. Example is that when you collect an overdraft from the bank, for example, you have a fixed amount that you have in the bank, then you tell the bank that, oh, I want to withdraw more than that. Let's say you have $500. Then you tell the bank, I want to withdraw $1,000. The bank will come to agreement with you so that you withdraw the amount. You call it overdraft. You are withdrawing more than what you have. So definitely the bank is going to charge you for that particular amount that you have overdrawn. And what is an interest that is to appear in your bank statement that you will not be aware of. Okay. Now 5, we are coming to the bank reconciliation procedures. This is how we do bank reconciliation. A, take the cash book and ensure that it's accurate. Take your bank deposit book and ensure all deposits have been debited in the cash book. Also, take your check or withdrawal book and ensure that all payments have been credited in the cash book. Make sure that any errors have been corrected, especially arithmetical accuracy is correct. So the first thing that accountant should do is that accountant should make sure that the cash book is what is correct. It's correct in the sense that you take all deposits, all the deposits form. Then you go through your cash book at the debit side. You make sure that all has been what deposits have been what debited. Then you take your checkbook. Then you look at your credit side and make sure that in the cash book all the items all the checks have been credited in the cash book so that it is complete. Apart from this, if there's any other errors, then you correct it to make sure that your cash book is accurate. Okay, after you've done that, then B, take the cash book and reconcile it with the bank statement. That is, all debit in the cash book has been credited in the bank statement. In the bank statement, and all credit in the cash book has been debited in the bank statement. The reason why the cash book and the bank statement have opposite entries that business is a payable or a creditor to the bank. So the next stage is that you reconcile your cash book that you know that is correct with the bank statement. You take the bank statement and the cash book. Then you make sure that all debit entries in the cash book or it also has been credited in the bank. And all credit in the cash book has been what? Debited in the bank. The reason why the bank and the cash they have opposite entries, that is when the cash book is debited, the bank is credited, is that the cash to the bank, every individual organization is what? A payable or creditor to you. So when you debit your cash book to increase the amount to the bank, it is what? They are owing you the amount. So the amount will be credited. That's your creditor or payable. That's why they have opposite entry. So when the cash book is what? Is credited, the bank should be debited. Okay. C. All the debit entries in the cash book not credited in the bank statement is uncredited checks in all credit entries. And sorry, let me read it again. C. All the debit entries in the cash book not credited in the bank statement is uncredited checks. And all credit entries in the cash book not found or debited in the bank statement is unpresented checks. These two should be noted down. Also, all entries in the bank statement not found in the cash book noted down. So what I'm saying that when you reconcile your bank statement with your cash book, that you take your cash book and you take your bank statement, and you realize that you've debited an amount in the cash book, but it has not been credited but in the cash book. It's what uncredited checks. When you take your cash book, then you credit amount in the cash book, but it has not been what debited in the bank statement. It is what unpresented checks. Let me go over again. Unpresented checks. It means that you have credit amount what in your cash book, but it has not been what debited in the bank statement. It has not been presented, so it has not been debited in the bank statement. It is called what? Unpresented checks. Okay. When you debit your cash book and it has not been credited in the bank statement, we call it what? Uncredited checks. I hope it is clear. Okay. Then apart from that, any entries found, so you know these two down, the unpresented and uncredited, you know them down. Then apart from that, any other entries in the bank statement but not also in the cash book should also be noted down. Let's continue. Then D. Then after all this, then you have to what? You have to prepare the cash book again. We call it the adjusted cash book. So D, adjusted cash book. An adjusted cash book is written with the closing balance of the cash book. Then all the entries in the bank statement not found in the cash book are included and a balance obtained. So you take, you have to do the cash book again. You call it adjusted cash book. You take the balance in your cash book to do that. Start with the adjusted cash book. Then all entries in the bank statement that the debit and the credit are not found in the cash book will be included. So if there's a debit in the bank statement, there's a debit in the bank statement, but it has not been credited but in the cash book, then you have to include it. If there is a credit in the bank statement, but it has not been debited in the cash book, then you include it. I hope it's clear. It is clear. Let me go over again. That you start with the adjusted. You do your adjusted cash book. You start with your adjusted the balance from your cash book as the opening balance. Then all debits in the bank statement, all debits in the bank statement not credited in the cash book, you credit it. Then all credit in the bank statement not debited in the cash book, but you include it. Then you obtain what? A balance, a new balance. Okay. E. So after you done your adjusted card book and you've got a balance, then you continue. E is then that you prepare your bank reconciliation statement. How do we do it? A bank reconciliation statement is then prepared. It can start with either the bank statement balance or the adjusted cash book balance. So you can start with either the adjusted cash book balance or the bank statement balance. Okay. But most popular one is for starting with the adjusted cash book balance. That is very, very popular. Starting with the bank statement balance is not the popular. The popular one is starting with the adjusted cash book balance. So let's see how you do it. So it starts with the closing balance of the adjusted cash book. Okay. Then unpresented checks are added to it and uncredited checks deducted from it. Unpresented checks are added because in our cash book, it has been deducted, that is credited. But in the bank statement, excluded, that is debited. That is our cash book balance has been understated. So we have to add it back with uncredited checks. The cash book has been what? Debited. Let me read this statement again. E, bank reconciliation statement. A bank reconciliation statement is then prepared. It can start with either the bank statement balance or the adjusted cash book balance. But most popular one is starting with the adjusted cash book balance. So we can start with the bank statement balance or the adjusted cash book balance, but the adjusted cash book balance is the most popular. So let's continue. So let's see how we do it. It starts with what? The closing balance of the adjusted cash book. Then unpresented checks are added to it and uncredited checks deducted from it. So when you start with the adjusted cash book balance, then you add unpresented checks to it. Then what? You deduct uncredited checks to it. Why? Unpresented checks are added because in our cash book, it has been deducted. That is credited, but in the bank statement, excluded, that it has not been debited. That is our cash book balance has been understated. So we have to add it back with uncredited checks in the cash book. With uncredited checks, the cash book has been debited. That is increasing the amount in the cash book. However, the bank statement has not credited it to increase the amount in the bank statement. As such, our cash book balance has been overstated. We therefore have to reduce it by deducting it in the bank reconciliation statement. So all that I'm saying that in your cash book, you have debited the amount that I'm talking about, the unpresented check. You have debited the amount that you excluded it in your cash book. But the bank, they have not debited it, they have not received the amount. So you realize that your cash book amount has been understated. So you have to add it back. So also applies to the uncredited checks. The uncredited checks, the reason why you have to deduct that you have increased it. You see, in your cash, you have debited it, that's increased it, but in the bank, it has not been increased. So what? It has been overstated. So you have to be deducted from it. Okay. Okay. So the balance of the bank reconciliation statement should therefore be equal to our bank statement balance. If still there is a difference, then the cash book and the bank statement be scrutinized and errors or mistakes corrected. So after we've done your bank reconciliation statement, you see that still there are errors, then you have to go through your cash book to identify any mistakes, or the bank should also be notified so that they also check their entries to make sure that any mistake has been or errors have been corrected as soon as corrected to balance. Okay. note basically what has been done in the bank statement but not reflecting in the cash book will be corrected in the adjusted cash book, including errors committed by the accountant. So all that I'm saying that what has been done in the bank statement but it's not reflecting in the cash book will be will be done or corrected in the adjusted cash book by what? By the accountant. Okay. Also, all entries included in the cash book not reflecting in the bank statement will appear in the bank reconciliation statement. So all entries in the cash book not appearing in the bank statement also will be corrected through the bank reconciliation statement. So entries like unpresented checks and credited checks will be corrected through the bank reconciliation statement. Now let us look at the format. So these are the format. For the adjusted cash book, this is the format. Adjusted cash book. Then you have your debit and your credit. For your debit side, the balance brought down from your cash book should be here. Then any credit transfer should be added. Then interest received should also be debited. Dividend received should also be debited. Okay. Then the errors committed in the cash book also will be debited to it. Then when you come to the credit side of the adjusted cash book, these are the entries that will be made there. Standing order payment will be what? Credited. Bank charges credited. Interest charges credited. Then dishonored checks also credited. Debit transfer credited. Errors committed in the cash book also credited. Then the balance will be carried down to so this is the balance of the what? Adjusted cash book. So then we do a bank reconciliation statement. We start with the popular one, the bank reconciliation statement. So you give it a heading. The bank reconciliation statement as at that period. You start with what? This balance, which is the adjusted cash book balance. So adjusted cash balance, that is here. Then you add your unpresented checks. Then you get an amount. Then you less uncredited checks from this amount. So the balance should go the bank statement balance. So this balance should agree with the bank statement. If it does not agree, that means there's a problem. You have to identify it. Or the other alternative, you give your head bank reconciliation statement as that. Then you start with what? The balance per bank statement. That will you use the bank statement balance to start with. Okay. Then you add all uncredited checks to it. You get the amount. Then you less unpresented checks to it. You get the amount. So after that, you deduct it from this figure, and this figure what should be the balance per adjusted cash book balance. So after this, that means what the cash book balance and the bank statement balance should what? But the balance that this figure, the adjusted cash book balance should be equal to this. Should be equal to this. When you use the second method, that is when you start with the bank statement balance, then you should get this figure. These two figures should be equal. Okay, that's when you start with what? The balance per bank statement. But this one is the most popular one. Okay. C, when there's an overdraft. That is when the amount that you have in your bank, you inform the bank that you want to withdraw more than that amount. So there's an overdraft. But when there's an overdraft, as you heard the bank reconciliation statement as at that period. The balance per adjusted cash book, normally it will be what? It will be negative balance. That's why then you add uncredited checks to it. So you change the position, you do the reversal of the starting with what? The bank, the adjusted cash book balance. You do the opposite. So you have add uncredited checks to it, then you get this figure. Then you less unpresented checks, you get this figure. So the balance per bank statement, that's when it is an overdraft. You reverse this. When it's an overdraft, and you want to start with the adjusted cash balance, you reverse all this, and this one will come here, and this one will come here, or this, but you start with what? You start with when it's an overdraft and want to start with what? Adjusted cash balance. So when you want to start with that, when there's an overdraft and you are using the adjusted cash balance, that's the format. Okay. D, where there is a wrong debit or a credit by the bank, that is when the bank wrongly debit an amount or credit amount. This is the procedure. They, as usual, your head the bank reconciliation statement asset. Okay. Adjusted cash balance is always there. Then what? You unpresented checks. Then whatever wrong credit that the bank has, and then what? You add it to it. So the unpresented check plus the wrong credit, you get this figure. Okay. Then you come here. Let's uncredited checks. Then you add any wrong what debit to it. Then when the bank debited your account, you add it to the unpresented so that you get this figure. So your adjusted cash balance plus these two figures, then you get this balance. Then you add all together. Then you deduct this. This figure is what? Uncredited checks plus the wrong debit that the bank they've done. You get this figure. You deduct from this figure, which is the adjusted cash balance plus this. You get this figure by what? Adding unpresented checks to the any wrong credit that the bank has done to get it. So we add these two together. Then that is from this figure. This figure is what? Uncredited checks plus wrong debit. You add this figure so that you deduct it from the cash balance plus this. You deduct it so that you get the what? Balance at the bank statement. That is when there's what? This format is what? When there's what? Wrong debit or credit by the bank. That's when you use this format. E, correction of error by the bank. So when there's an error in the bank statement, this how you go. You start with your bank reconciliation statement. Then you adjust the cash balance is there. Unpresented check is there. Then wrong credit is there. Then add error that overstate the balance. So you add that particular one to it. So when there's what? While there's error in the bank statement, then what? You add it to it. So this one, unpresented checks, wrong credit and what? Overstatement of the balance. Then you add it, then you obtain this plan. So the adjusted cash balance added to this to get this figure averages. Okay. Then you less uncredited checks, wrong debit, and errors that understate the balance in the bank statement. You add it to it. So you add these three together, you get this figure. So the opening balance, the cash book balance, adjusted cash book balance. Then you add this, which is unpresented checks, wrong credit, and error that overstate the balance in the bank statement. You add these three together to get it. Then the opening cash adjusted cash book balance added to this figure, you get this figure. Then these three uncredited checks, wrong debits, and what and the statement in the balance, you add all together to get this figure. So this figure, one of these should be equal to what? Your balance per bank statement. So I will end here, then continue. We continue the next time by what? By looking at examples. I've told you that accounting, you have to work more example. So and also watch more videos. So what we have done today, please take time and watch it over several times. So your accounting is a principle. The more you watch it, the more you understand it, the more you become familiar with it. So I'll pause here. Next time we continue by looking at examples. So please, what you've learned today, don't think that you are okay with it. Watch it several times. And as you watch it several times, you become familiar with it. And also what you can understand it and also do your bank reconciliation statement easily. So we are going to end here. But before we go, I want you to please, I want you to like and also share this video. It will motivate me a lot. And also I want you to comment whatever so that I can improve upon my videos for a better video. And also I want you to subscribe. When you subscribe, I'll be doing 2 or 3 videos every week so that it can be sent to you. Also, if you want to learn accounting, you are an accountant, you want to learn accounting like a businessman, I have my email as well as telephone number at the show more section. Click on the show more section, show you my email and telephone, you can contact me. Also, if you're a student and you are facing problem with your accounting, you are finding it difficult to pass your accounting exam, you can contact me through my email or my telephone number. My telephone number is the same as my WhatsApp number below, so that I can help you out. I always say that what gladdens my heart is I teach a student. The students go to the exams and come out with flying colors. That's part of the exam. It gladdens my heart. So you can also contact me. And also, as I said, I'm an ACCS chartered accountant. I provide account bookkeeping service, including other accounting services. So if you want to, you don't have an accountant, you want somebody to keep your books for you, you can also contact me. As I said, if you also want accounting tuition, you can also contact me. So I will end here and watch out for my next video. Bye.